He who fails to plan is planning to fail. I'm sure you've heard that quote. It's one of those famous ones by Winston Churchill. And coming from someone who successfully led Britain through World War II, I'd say it's probably a good idea to pay attention. The quote and the principle of what Churchill said applies beautifully to life, relationships, work, every endeavor, and yes, even crypto. So why do so many people fail in crypto? It's the same reason why so many people fail in many different areas of life. There was no plan. There was no mechanism in place to anticipate the many different scenarios that could become reality. So what is a plan anyway? A plan is defined as a method for achieving an end or a detailed formulation of a program of action. As a verb, it's defined like this: to devise or project the realization or achievement of. Simply put, it's an anticipation tool. A plan is this thing you sit down with and you formulate so that you're prepared for whatever the new business throws at you when you're building it, or whatever challenges arise in the new relationship that you're pursuing, or yes, whatever ups and downs you'll experience on the volatile roller coaster of crypto. And it's a very volatile roller coaster. Nearly 1 in 5 businesses fail within their first year. About 90% of startups fail. 95% of traders lose money. So much failure. And the majority reason is because there was no plan. As far as succeeding in crypto goes, it doesn't have to be overcomplicated. And while there are multiple different ways to accumulate and invest into crypto while minimizing risk of failure, trading simply is not one of those ways. A lot of people dream of momentum trading an hourly chart, making $1,000 a day on their 5 computer screens. And while there are some successful traders doing that, most of what you see online advertising that dream is just that, a dream. But let's talk about one of the more conservative strategies that data has proven to work. And let's look at real-world examples and numbers of how. The best part about it is that it does not have anything to do with trading or timing the market, which, as you may have guessed, most people get wrong anyway. So here we have a zoomed out Bitcoin chart, and it is something else to look at. This is on the weekly, and you have a bear market low here that we're looking at in 2018, a bull market high in 2017. We're gonna break down some extremely interesting data to show you this one strategy and how it works. But first things first, if you just zoom out and you just go all the way back, and you can see Bitcoin in this trend of higher highs and higher lows. This is really the trend of crypto, this early stage technology, and it's still so early. If you look at Bitcoin in 2011, for instance, you see around $2 to $3 Bitcoin, and it's just been growing steadily over time. The market cap of crypto as a whole growing steadily over time. You see the draw. You see what attracts people. You see what attracts entrepreneurs and investors and traders and people that are just looking to become financially free. You see what attracts them. It's this chart. It's the growth of crypto. And it's seeing other people that are in the space finding success. People want to mirror that success. They want to get into crypto and they want to mirror that success as quickly as possible. But I want to just show you why it's not so much a short-term plan that most people succeed in crypto. It's a long-term plan. It's an accumulation plan. And there are many different strategies. There's many different ways. There's many different tools that make up the overall toolbox that works in that plan. And in this video, I want to show you one very powerful way. And it's the most probably hands-off way that many have found success in crypto. It's called dollar cost averaging. We're going to look at a couple different examples of how powerful this is, but just to show you, in case you're unaware what dollar cost averaging is, Bitcoin dollar cost averaging consists in investing a fixed amount of USD into Bitcoin on regular time intervals. You'll often see it referenced by its abbreviation of DCA. Purchasing $10 every week, for example, would be dollar cost averaging. This strategy is mostly used by investors that are looking to purchase Bitcoin for the long term, since it protects them from potentially allocating all their capital at a price peak. And before we show these examples and how powerful it is, I just want to say that many people that are in crypto, even if they've been here for years, but especially new people getting into crypto, they tend to buy emotionally or even sell emotionally. And a lot of times you see people that buy in on the hype. They're buying the top and they're putting a lot of capital in at that moment because they're trying to ride the success of the market, the parabolic success. A lot of people in a fearful environment, in bear market lows, they do the opposite and they sell crypto. They sell their Bitcoin at bear market lows. They're kind of selling into the fear when the exact opposite is happening. This is where the opportunity is, and this is also where the greed is, right? So people buying the top, and then unfortunately people selling the bottom. It's what you want to really stay clear of. And dollar cost averaging is one strategy that really helps in that regard because you're on just a set time frame. But let's look at how this works. And I thought the most powerful way to do this and to show examples would actually be to go from one end of the spectrum and then compare it to the other end of the spectrum. And what I mean by that is this. Let's say we started DCAing, dollar cost averaging at a bull market high, meaning actually started buying at a market top, a cycle top, and actually dollar cost averaging, look, even all the way into the bear market. But let's look at that first example. So if you started doing this in December of 2017 and you just dollar cost averaged every week for 5 years, meaning basically so far what has happened in crypto. Let's look at this example. So on the left, you see this purchase amount is $100 a week. It's weekly for 5 years, starting on December 2017. That's that bull market high. It's a total of, over the years, $24,800 invested. And you be left with $97,254. Now this is if you started dollar cost averaging Bitcoin right here. And you can even just see on this chart, it actually compares, well, what if you did the same thing and you invested $28,450 into gold, and that's what this middle one is. You'd see a 14.72% change. And you can see it's actually $28,450 is what you're left with off of the $24,800 investment. Now, if you're looking at that percent change and you're comparing it to Bitcoin, you can see a huge difference. That's 292.5% change when actually beginning to accumulate at a bull market high. And I think the beauty of it that I should just point out is the fact that it required nothing else than to just press a button in an exchange of some sort that allows you to set your buys and dollar cost average. And it required no other work other than just setting it and forgetting it. And that's at the bull market high of 2017. Then I wanted to actually say, okay, what if you actually started in a bear market low and you started dollar cost averaging in a bear market low? So here's a similar example. When we set it for over here on the left, you can see December 2018, which again, looking at the chart, is the bear market low of 2018. You started dollar cost averaging there. Total invested over the years is $19,600. And you can see $67,945 is what you're left with. In something like gold, you'd be left with $21,168. So it's 246% versus 8% change. There's a powerful, powerful example right there in comparing it to gold. Now, interestingly enough, if you look at these two examples, you can see 200% plus gains. So 292% gains buying a bull market high. And we have 246% gains buying a bear market low. And that's starting to accumulate at those areas, right? So this is a perfect example to show you that it doesn't even matter actually if you start dollar cost averaging at a bull market high or a bear market low. It doesn't matter. This is based on historical data, of course, but it would not matter where you did that. There's 200+% gains each way. And you can actually see buying at the 2017 bull market high delivered even more gains. And the reason why that is it's because the time in the market is even longer, right? And even the time accumulating going into the bear market low was longer. So that is a huge example of one strategy that you can use, and it doesn't even require any trading. It doesn't require any timing of these markets. Now, when you start bringing in all the other tools in crypto that are available, and you pair that up with dollar cost averaging, and you understand the cycles of crypto, things get very powerful. But there's a lot of people out there that enjoy just dollar cost averaging because they don't have to do any of that. They can just take this one strategy, this one method, and they can set it and forget it. So that's dollar cost averaging. These are some examples of what it looks like, the power behind it. It will be very interesting to see the data and how moving forward this continues to play out, how Bitcoin gains percentage-wise compare to things like gold. Time will tell as this early stage space continues to grow. Thank you so much for coming by. I really, really, truly do appreciate you. God bless.